Hello everyone, let us continue with our discussion. In the previous lecture, we have started with the topic that is Introduction to Financial Statement, and in the first lecture, my purpose was to help you to understand the process which we actually follow to analyze our financial statements. Clear? Now coming to the second LOS, that is write down LOSB. Write down describe the role of financial statement analysis. Describe the role of financial statement analysis. Describe the role of financial statement analysis. Clear? Now, over here, my first question which I ask myself, or you can ask yourself, why do we even do financial statement analysis? Clear? So let me ask you a question. This is the first thing, that why do we even do financial statement analysis? To this question, we will answer with this LOS. Okay. So if you had to lend 50,000 to your friend, would you give it blindly, or you will try to understand it first whether he'll be able to return it to you or not? Hopefully you got the point. Suppose you will pay me, okay, or you have given me 50,000 rupees with an expectation that I will repay it to you. So you will check my ability whether I'm able to repay it to you or not. Suppose I don't have any job, I don't have any business, I don't have any assets, I don't have any savings, then how come I'll repay you those 15,000? Clear? So you have to ask yourself. Similarly, now you are doing the same thing to a company. Clear? That you have to give the money to the company in the form of debt or in the form of, say, equity. Clear? A company can take the money from you in two forms, equity or debt. Clear? So you are giving the money to the company, so you need to analyze now whether the company repay it to you or not. Very important question. So that's what the financial statement analysis is all about. You analyze before giving your money to the company. Clear? So it's you who is giving your money to a company either in the form of equity or in the form of debt. But definitely if you're investing your money, you want return out of it, and you want your money back as well with return. So you need to analyze that whether the company can repay you the money or not. Clear? So write down what is financial statement analysis. Write down what is financial statement analysis. What is financial statement analysis? It simply means it simply means it simply means reading and analyzing a company's financial reports. Reading and analyzing companies' financial reports like balance sheets and income statements, and then making smart decision based on that information. It's just like a doctor who actually reads all your test reports before giving you a diagnosis. Similarly, the investors and lenders, they will read the financial statement before giving the money to the company. Clear? Now why do we analyze this financial statement? Point is clear. You have to give your money to the company and you want to check whether the company can repay the money back or not. Clear? Now write down point number 1. Investors use it investors investors use it investors use it to decide where to invest. Investors use it to decide where to invest. Clear? So we know that we have thousands of stocks listing on the exchange, and I have a limited money. So where I should invest? The company which is strong, fundamentally strong, and the possibility of getting the higher returns in the future. So for that, I'll do the financial statement analysis. For that, we will do the financial statement modeling. Clear? I will need to analyze which company is making profit, whose company's sales is actually growing, which company is carrying too much of debt, which company is debt free, which company is cash rich. Clear? So this exactly what investors do. They use the financial statement analysis to pick the right company so that they can invest in. Clear? Similarly, if you are a bank, you have to analyze a company before giving them a loan. Similarly, if you suppose go for an education loan, so they will ask for all your papers, your bank statement, your income tax return, whether you own a property or not. So they will get all the information and then they analyze whether are you capable enough to repay the loan or not. Similarly, the bank will analyze the company before giving them a loan. Clear? So that they can understand that whether the company is profitable or not. If it is not profitable, then how they will repay back the money. Clear? Do they have enough cash flow that they can pay the EMI every month, EMI on time, or they have too much of old debt which they are unable to pay and now they are restructuring it. I will discuss this portion of restructuring later on. Clear? So after checking their financial statement, they will approve the loan and they also decide what interest rate is best for them. If the company is very risky, the interest rate is high. If the company risk is low, interest rate is also low. Clear? Credit rating agencies, they are also going to use financial statement analysis to assign them the rating, like CRISIL or Moody. Okay, they assign the rating like a particular company belong to AA plus, belongs to triple B, belong to A category, belong to triple A category, to the companies, and these ratings tell us that how safe or secure a company is. Clear? And whether we should invest in their bonds or not. If the company is very risky, suppose their rating is D, so I'm not going to invest my money in that particular company because it's very risky. Clear? So they are going to analyze this rating based on their financial statements. Are you clearing? Now suppliers. Okay, supplier are also going to use the financial statement analysis, because if someone is supplying, these are the suppliers, they are supplying the goods to the company. Clear? Whether the company can repay the money on time or not. Clear? So before giving them a credit, suppliers, before giving the credit to the company, they analyze that whether they can repay the money within time or not. Clear? So for that, they will also check their financial statement. Are they in a good financial position or not? Because they have to pay the money to me in 60 days. So are they already struggling? Then how they will pay? Clear? So the role of financial statement analysis is also very huge in terms of trade decision as well. Clear? So both internal as well as external users are going to use the financial statement to analyze and to understand that whether we should put our money in the company or not, whether it is investors, whether it is banks, credit rating agencies, or whether it is suppliers. Now when I say internal and external, so there are internal means the management. Okay, means I am the company, this company belongs to me. Okay, I'm the management. So it's also useful to me as well when we are going to decide that okay, whether we should launch a new branch, we should launch a new product, we should cut down the cost to improve the profitability. So how will I get this data? When I will start analyzing my own statement. So I am a company, I am the management. Clear? I am analyzing my own statement to decide where I can grow, how I can grow, when I can launch a product, how I can do the cost cutting, everything. Clear? Now after doing all these analysis, what my point is, suppose I feel that my cost is huge and that leads to the lower profitability. So what I'll do, I'll start cutting down the cost. So how this is possible? When I have my own financial statements in my hand. Clear? Now the only difference is management have more internal data about the company as compared to the outsider. There are few things about the company which a supplier don't know, which a bank don't know, which investors don't know, but management know because they are doing the business. They are in the company. They know every input and output, what's happening, how it's happening. Every information is there with them. Are you clear? So this is the role of the financial statement analysis from the eyes of multiple vendors, whether it is investors or whether it is a bank or whether it's the management himself. Clear? Now coming to the third LOS, which is very important from this chapter's perspective, LOC. Now it's about the importance of regulatory filings, clear, financial statement notes, supplementary informations, management commentary, and the audit reports. So we are going to study about each of them in minute detail one by one. Clear? Now give the heading, the importance of regulatory filing. The importance of regulatory filings. Importance of regulatory filings. Now, when I say importance of regulatory filings, means everyone have to submit their documents, their financial statements with the regulators. Now, if you'll ask me importance, so I tell you it's something that ensure honesty, trust, and discipline in the world of finance, and that is actually the regulatory filing. It's their discipline, it's their set of rules which everyone have to follow. Clear? So think of how a school works. Okay, like teachers, they create the syllabus and the rules for the exam, then principal and the exam board, they make sure that students follow these rules, and now you go for the exam and appear and submit your results. Then examiners will check whether you have cheated or not. Clear? And then the results are shared with the parents. Are you clear with this scenario? Teachers, principals, you, external examiners, and result. Similarly, when I say teachers, see, if I'll teach you in this way now, you will never forget it. That's the best part. Teachers like FASB, FA, FASB and IASB. Okay, they are the one who are going to draft the syllabus and the rule for the regulatory filings. Clear? Then we have principals and the examination board. Principal and exam board they are like SEC. Clear? I'll discuss each of them in detail. SEC is Security and Exchange Commission, or other regulators, like in India we have SEBI. Security Exchange Board of India. Clear? So they are going to make sure that students are going to follow the rules. Student means the company are going to follow the rules which have been created by FASB. What is FASB? Write down. Financial Accounting Standard Board. What is IASB? Is the International Accounting Standard Board. So they are going to set the rules. Principal and Examination Board, they ensure that the companies follow the rules. Clear? And you as a company, okay, you will submit your reports. It's you. Clear? Student, in other words, company, submit financial reports. Then external examiners, they are the auditors. They will check your reports. Whether you have cheated or not, whether there is any mistakes or not. Clear? And then finally they will publish the result. Clear? Examiners will finally publish the result, or you can say they will finally publish the financial reports. Clear? And now it will be shared with the students' parents. So who are the students and parents? Investors, creditors, creditors and public, investors, creditors and public. So they will see that how you have performed, they will see that how you have performed. Clear? So if there is no such system, everyone can make their fake mark sheet, they can lie about their performance, still they will get the reward. That's why regulation is important, to ensure transparency and fairness. Clear? So they will define the rules. SEC and other regulators like SEBI in India, they will ensure that companies follow the rules. You submit your financial reports, then auditors will check your financial reports, and then they will publish the financial reports to the investors, creditors and to the publics to ensure transparency and fairness. Clear? So this is just to set the theme. I have given you the whole theme of what we are going to study. Clear? But now we are going to study them in detail. Clear? So there will be approximately 7 points we are going to cover up. Clear? Now write down the first point. Point number A. Standard setting bodies. Who makes the rule? Standard setting bodies. Now write down who make the rules. Who make the rules which everyone is following. Clear? Write down, these are professional bodies. These are professional bodies made of accountants, and experts, full stop. They create the accounting standards. That company follow. They create the accounting standards that company follow while preparing the financial statements. Now there are two main bodies. Number one, FASB. FASB make the rules for companies in the US. Make the rules for the company in the US. Called US GAAP. Then we have IASB. Make the rules used globally. Including Europe and Asia. Known as IFRS. The rule book name is IFRS. Clear? It's just like we have CBSE and ICSE. They are the different education board with different syllabus. Similarly, FASB and ISB are two different boards with two different set of rules, and the aim of both is to evaluate the performance honestly for the companies. Clear? This is our point number A. Now point number B. Regulatory authorities. Who enforces the rules? Write down, these are government backed organization. These are government backed organization. That make sure companies follow the rules. Made by FASB and IASB. Make sure that company follow the rules made by FASB and IASB. Clear? Write down examples. SEC. It's in US. It enforces the compliance in US listed companies. Then we have FCA for companies listed in the UK. for companies listed in the UK. Similarly, we have SEBI, Security Exchange Board of India. It's for India. It's for India. Clear? Our regulator for financial market. Clear? They ensure three things. Write down. They ensure three things. They ensure three things. Number A, companies submit timely financial reports. Companies submit timely financial reports. Clear? Then the reports are accurate. The reports are accurate. Clear? And point number C, no insider cheating or manipulation. No insider cheating. No insider cheating or manipulation. No insider cheating or manipulation. Clear? So if FASB is the teacher who is setting the exam, then SEC is actually the invigilator in the examination hall who makes sure that students don't teach. Clear? So they are the teacher who prepared the questions, and these regulatory authorities are your invigilators in the examination hall to ensure that you are not cheating. Clear? Now coming to next point, point number C. Write down IOSCO. IOSCO. Making it global. Write down making it global. Making it global. Now you may ask, if every country have its own rule, now what about this global investors? What about this global investor, and what is the role of ISCO? What is the role of ISCO? Clear? It's like the United Nation of regulator. Write down. It's like United Nation of regulators. United Nations of regulators. It's like the United Nation of regulators. Full stop. It connects regulators from over 95% of the world market. So basically all the regulators of the world are connected to the IOSCO. Clear? 95% of the regulators are connected to the IOSCO, and it ensures, write down, it ensures cooperation across countries. It ensures cooperation across countries. Full stop. Promotes global standards. Promotes global standard. So investor in Japan, Germany or India can understand and trust the report of a US company, so that investors in Japan, Germany or India can understand and trust the report of a US company. Clear? Now they have three goals. Number one is to protect the investors. Second, making market fair and transparent. Third, reducing the systematic risk, that is the big crash. Clear? For that purpose we have ISCO. Clear? So that we can make it global, and to ensure that the investors in different part of the world can understand the reports of the US company and they can trust it. Most importantly, they have used the word trust it. Clear? Write down one more important point. ISCO is not a regulatory body. ISCO is not a regulatory body, but its members work together, to improve cross-border cooperation, and make national regulation and enforcement more uniform around the world. Clear? So it is not set up by the government. Clear? Just like we have regulatory authority which are actually backed by the government, but this ISCO is not backed by the government. This is the difference. Clear? Now write down point number D. What must companies disclose? What must companies disclose? Clear? So according to the regulators like SEC and the principle of IOSCO, company must share their accurate and complete financial information, disclose all the possible risk. If there is any pending lawsuits or debt problems must be disclosed properly, and provide reports on time. Clear? These are the three mandatory things which a company must disclose. Clear? Now coming to point number 5, that is Sarbanes-Oxley Act. Write down Oxley Act. It's for US. Clear? It's for keeping the auditors honest. Write down, it's for keeping auditors honest. It's for keeping the auditors honest. So after that big Enron scandal, okay, where the company have created their own books and fooled the investors, the US introduced a strict law, that is SOX, in 2002. Clear? This is a very strict law introduced by the US in 2002, when after a very big scandal, that is Enron scandal. Clear? They have actually created and drafted their own financial statements to fool the investors, because at that time there were no such rules and regulations. Clear? Now its key features, write down its key features which you should mark. Write down point number 1, external auditors can't do consulting work for the same company. External auditors can't do consulting work for the same company. Why? To avoid the conflict of interest. Because if I'm consulting them, clear, if I'm suppose I'm consulting you, so I'm consulting you for your growth, for better profitability, for better future, more sales, more efficiency. Clear? Now if I am the one who is the auditor, that means I am biased. I have to ensure that your financial statements look good as a consultant, but as an auditor I want fair and true picture. So these two are conflicting with each other. That's why they come up with the rule: the external auditors can't do consulting work for the same company because the interests are different. Clear? So you should not work for the same company. Clear? Top executives like CEO, CFO, CRO, CTO, okay, chief operation officers must personally sign the financials are correct. They must personally sign that the financials are correct, because they are the one who can make the changes, because they want to show that company is working well, making profits. But if they are signing it, that means what? They are taking the authority of it. Clear? And if anything goes wrong, they will be punished because they have signed it. Clear? Next, companies must have strong internal control. Write down, companies must have strong internal controls, and even the auditors must confirm that they have a strong internal control. Clear? Now the purpose is they should not hide anything and everyone is accountable. Clear? If there is any cheating, any fraud, whoever have signed the documents, they will held responsible for it. Clear? Write down point number 6, that is proxy statements. Proxy statements. Write down shareholders right to know. Shareholders right to know when big decisions like electing the board members, giving stock options, or approving salaries, okay, they come up, company must send a proxy statements to the shareholders. Now this proxy statement will include the details of the people being nominated, their qualifications, their proposed compensations, and voting items. Clear? So this will give the shareholder the power to make the informed decision whether this particular person should be hired or not, being a board member or being the CEO, what salaries they are going to get, are they going to get the stock options or not, what's their jobs and responsibilities, what are their qualification, whether they can handle the company or not properly. Clear? So all these information will be properly mentioned in the proxy statement. Clear? Then what about the Europe? Till now what we have discussed is for the US. Okay, now each European countries, they have their own security law, but they all follow the IFRS for consistency. See, they follow the IFRS, but they have their own security law. Clear? Now write down, they also have the ESMA. ESMA. Now what is this ESMA? Write down, European Security and Market Authority. European Securities and Market Authority. Its main whole and sole purpose is to coordinate the regulation, Then we have European Commission. It actually oversees everything from a policy perspective. The purpose of setting up this body is to oversee everything from a policy perspective. So whether a company is in France or a Germany, whether a company is in France or Germany, their financial follows the same standard, making it easier for the investors across the Europe to understand the financial statements. Clear? So one thing is clear, financial statement must be reliable, companies must not mislead the investors, their fairness and transparency in the market is very important, and global investors can trust what they are reading in the financial statement. Clear? Okay, so I'll keep this much in this lecture and continue ahead in the next lecture. Thank you.